Hey guys, today I'm going to shoot a video about cash flows. I've had quite a few clients, friends, family reach out to me and say, "Hey Dom, I'm interested in buying another property. I want to buy another investment. May own their own home, but they are scared that if they buy this property, it's going to cost a lot, and they're not sure what would happen if they didn't receive rent or what it would look like if they put in different deposit amounts. Really, it all comes down to the cash sensitivity. They're scared to see what's going to happen if they own this property, and then what does it look like holding this property over time. Now, I try not to dive too deep into those conversations because I want to get specific, and talking numbers without showing people can be a little bit confusing. So today, what I'm going to do is take you through a cash flow analysis. I'm working on a live deal. It's one that we've got in Sydney. It's a three-bedroom, three-bathroom, double-car garage. Oh, it's not double-car garage, but two cars, one inside the garage. Just out of about 35, 40 Ks out of the CBD. Now, what I'm going to do now is move my little face aside, not so little face, and take you through this cash flow now. So in this instance, we've bought a $630,000 property, 630K. When you buy a property, you have to pay some stamp duty. And we're lucky this calculator does all the calculations for us. So in this instance, it would cost us about $23,685 in stamp duty. Then you have to pay for some transfer of titles, and then you have to pay your conveyancer. Let's make that $2,000. Shouldn't be too much more than 2K. Now we're going to have a look at what we're investing, so the cash that's required for us to buy the investment. Now, there's lots of different ways you can do this. If you're using equity, it's effectively pulling cash out of your own home to then buy this. So it effectively means that you're putting in no cash, so it would be 100% debt. In this instance, what I'm going to assume is you've got a 10% deposit and you've got the cash to pay for stamp duty here. So the total deposit amount is $88,831. Now, as we go down the line, I put a capital growth rate of 5%. The long-term average in Sydney is, for units, it's about 5 to 6, 7% at the top end. It's been annualized over the past 35 years. For houses, it's about 6 to 8%. So what we've done is gone quite conservative, and we've made it 5%. Now that 5% impacts the property price over time. As you can see, over 10 years, it's projected to be worth $1 million. What we've also got here is CPI. That is effectively inflation. Now, inflation impacts the value of the rent. Now, typically rent should move with inflation. Sometimes it moves faster or slower. And it also impacts the rental expenses. 1.5%. I think at the moment it's a little less than that. It's about 1.1 or something. But what the government wants to do is typically target between 1 and 2%, or 3% good, but 1.5% is nice and conservative. Now, what I've also done is assumed that we're going to get $480 per week. This is a very conservative assumption for a brand new property, 3-bedroom in that area. I like to be very conservative with these numbers because if we work on the worst case, then everything else is cream. So if it performs better than that, fantastic. So I've got $480 in as rent. I've got a vacancy rate of, let's make that 3%. Vacancy rate effectively means the amount of time that the property is empty. Excuse the bus, I'm working from home today. So a vacancy rate of 3%, if it is 52 weeks in a year, and then you times it by 0.97, that effectively means that for about 1.5 weeks, nearly 2 weeks, the property's empty. And that's the churn if you're signing 12-month leases. And in Glenfield, in fact, it is less than 3%. So that's accurate. Now, we're moving here into the loan amounts and the interest rates. This part here can severely change what the property costs you. In this instance, we're assuming a interest-only loan. I won't go too deep into why interest-only versus principal and interest. In this little video, I will show you the two of them and briefly. In fact, what we'll do, rather than going interest only, we'll show you principal and interest. I'll make it a 30-year loan, and we'll make it an interest rate of 3%. We're trying to be conservative. So 3% over 30 years. Okay. Now, all the numbers are set. So if we go down the line now, let's have a look at what this property would cost us the first year running it. $480 per week with a 2% vacancy rate means you're getting $24,211 in your bank account. Then if you've got a principal and interest loan at 3%, you would be paying $17,280 in interest, in interest, and you'd be paying $12,141 in the principal part of your loan because you're paying down the loan. So you then have rental expenses. You got to pay some agent's commission, 5.5%. You got letting fees. You've got rates. You've got insurance, like your landlord's insurance. In this instance, you don't need building insurance because it's covered by strata. We've got some maintenance, so if things break. And then you've also got body corporate. So it's a small townhouse complex. There's going to be a small amount of body corporate to maintain the gardens and things. So, excuse me. So if you've got $24,000 coming in, and then you have to pay $17,000 in interest, $12,000 in principal, $7,000 in rental expenses, your out-of-pocket expense will be $12,322 per year before tax. So let's do that as a monthly figure. 12,322 divided by 12 is $1,026 per month to pay down this loan. Now, with brand new property, it is a very tax effective vehicle because you can depreciate the building. You can depreciate the building by 2.5% over 40 years. You can depreciate the fixtures and fittings. I've put it as a general fitting thing. So what that means is your carpet, your lights, all your miscellaneous, your oven, they all have different lives. So your carpet might be 10 years and it wears and tears and it gets worse. It drops in value. Same way your car depreciates in value. Now, excuse all the beeps. It's the middle of the day, so I'm getting lots of little messages. I'll put it all down. But what that means is you can effectively use this depreciation to lower your marginal tax rate or lower the amount of income that you pay throughout the year. What we've got here as well is some loan costs. I've put in your mortgage insurance, which is effectively your lender's mortgage insurance. Because I've only paid 10%, there would be about 2.5% lender's mortgage insurance, which you have to pay to the bank. Fortunately, a lot of people don't know this, but you can actually use that as a tax deduction, and you can write that off over 5 years. So for running this property, you effectively have $38,133 in deductions. Interest is a tax deduction. All your expenses are tax deductions. The fixtures and fittings and the building are all tax deductions, and so is the loan costs. Now, this is all going to start making sense in a moment. Let's assume that you are on $100,000. Is that one too many zeros? No, it's perfect. So that would mean at $100,000, you would lower your marginal tax rate by the $38,000. So you get a $5,000 tax refund, $5,100 tax refund. So if it costs you $12,000 through the year, you get $5,000 back. It means this property has costed you about $7,000, $7,200 per month, or about $140 per week. Now, what I'm going to do very quickly is show you what it looks like if you do interest only. We're going interest only. We'll make the interest rate a little higher. And here things change and become quite exciting. For the same investment, you're not paying down the principal component of the loan. So what that means now is the property through the year is going to cost you $2,000, $2,091. And then when you get your $5,700 refund, you're making $3,671. Yes, you can own a $630,000 townhouse in Sydney. You can put in a 10% plus costs, structure it interest only. It's only going to cost you $2,000 a year, but then after tax, it's going to make you money. And you can see here, if you were to get this little tax return, park it in your bank account, it covers each of the subsequent years. And it becomes quite interesting because you're holding this property, it's making you money after tax, and then it's also growing in value. So this property after 10 years, you'll have $444,000 in equity with only putting in an original investment of $88,000. So that's a nice quick cash flow. If you want to know more, reach out to the team and we'll do one specifically for you.